Coming up on the SBS On the Money podcast, my special extended interview with NAB Chief Economist Oster as he prepares to step down after 32 years, plus a close look at the Australian and Chinese economies. All next. Hi everyone, it's your daily 10-minute business and finance news wrap for this Wednesday, the 5th of March 2025. The Australian share market fell today by 0.7%. We'll have the details with Ben Richards from Seneca Financial Solutions soon. But first to my special interview with NAB Chief Economist Oster. He's preparing to step down from the role after 32 years. Now, I used to regularly interview Alan when I worked as a video journalist in Melbourne in the very early 2000s, but his experience extends way beyond then, also working through the 1990s recession. Before looking back at his career and his advice for aspiring economists, we discussed today's GDP data, which showed an expansion of 0.6% in the December quarter to be up 1.3% annually.
Well, I think the Australian economy has slightly increased its momentum, but the driver is still public sector demand. You then put in a few stocks adjustments and trade, and then you can get a 0.6, which is better than we've had, but it's still not great when you think about 12 months to growth rates of 1.3. That's not huge. It's about the same as what we had in December last year.
So for the first time in 7 consecutive quarters, GDP per capita grew. So the per capita recession, as it's been called by some, has ended. What does this all mean? What does it say about the consumer? And does it really reflect higher living standards?
Well, I think you're right. GDP per capita went up 0.1, so it wasn't a huge increase, but at least it didn't go backwards. I don't ever believe that you should use GDP per capita as your recession indicator, but at least it's saying that the economy is probably past the worst, and in that sort of environment, you would hope that we're going to get our soft landing.
So what do you think the RBA will think about it?
I think from the Reserve Bank's point of view, not much. I don't think they're actually seriously thinking about another rate cut until at least May. So we've got one in May. What I would also say is that RBA will be looking through ups and downs. It's a little bit better than they thought. Inflation numbers, unit labour costs are still pretty high. And so they're going to sit and watch the data for quite a while.
And given these numbers, what does it say about Australia's economic position in the threat of a looming global trade war?
It's very difficult to say. One of the problems is if they put on tariffs, the impact on the Australian economy is very, very small. But it's the indirect effect. So, you don't know what's going to happen in terms of the reciprocal sort of arrangements that other countries put back on the states, and you don't know what will happen to your trading partners, and you wouldn't know for sure what happens to things like equity prices and confidence. So in that sort of world, I think we would basically say, provided it doesn't get out of hand, the growth will probably be down in the international economy about 0.2, 0.3. Australia may be a bit less than that. But it's a very uncertain world, and you're just not sure how people are going to react.
Now, Alan, you're about to end 32 years as the Chief Economist at NAB. Can you run us through perhaps how the economy is different now to how it was when you started?
I don't think the economy is necessarily different, but I think the tools that we have to monitor it are much quicker. So, when I was in Treasury, I used to run the forecasting modelling area, and around the 1990 recession, we, as in Federal Treasury, did not know we had a recession for 6 months. Now, you've got monthly business surveys, and you've got monthly readings on consumer sentiment, and you've got data. And so, the example, when COVID started, for example, we were looking at various postcodes, and in Melbourne, Box Hill is very Chinese, and Chinese restaurant sales in 1 week went down 40%. So we thought, uh-oh, we've got a problem. So you know a lot quicker about where the economy is, I think, is the big difference. The economy is still essentially it's not just a sort of model that you press a button and get a result. It's almost like applied psychology. You need the model to give you a consistent view, but you can say, well, why does interest rates, you don't need to get to 18% to slow economy big time because the leverage is much higher. And so in that sort of environment, I think you just need to be very careful about trying to be correct all the time. You will not be correct all the time.
You're one of the few remaining economists who worked through the recession of the 1990s. Just how tough was it?
That was very tough. So to put it in context, okay, we didn't know for 6 months that there was a recession. 12 months later, the unemployment rate peaked at about 11.5%. So that was a pretty nasty recession. And 18% interest rates eventually killed the economy.
So how did it compare with COVID?
Well, COVID was much sharper in terms of the slowdown because essentially you shut down 50% of the economy. And then we also spent huge amounts of money trying to make sure that the impact was not as large as what it could have been. So fiscal policy, JobKeeper, all that sort of thing. There was a huge stimulus thrown at the economy. And so the parts of the economy that were still surviving were doing well. The other parts were basically shut. So the size of the falls were much, much higher. And one way to think about it is to give you a context. In our business survey, we have a measure of confidence. Normally it's around plus 5 points, plus 6. In the recession of 1990, it was minus 30. In COVID, it was minus 90. Just about everybody said, this is going to be really bad. And so that's the sort of differences.
Are there any significant calls you got right? And are there any significant calls you got wrong? And what did you learn from them?
I think what you learn from them, well, the short answer is yes to both. It's always good to finish on a high note, so it was good that we got the last rate call right. There's been a couple of times when the Reserve Bank completely blindsided everybody in terms of cutting rates and all that sort of thing. I think there was about 2015 when Glenn Stevens was there and he changed rates and nobody expected it. What it sort of tells me is in the Reserve Bank, they're people too, and most of them are economists. So, they can be as wrong or right as we can be. So it's not just, again, press the button and see what you get. It's a judgment, and it's, as I said, applied psychology is the best way to think about it.
A few weeks ago, the Reserve Bank highlighted the falling number of students studying economics. So what would be your message to young people considering studying the discipline, and why should they?
I think they should, because it opens up all sorts of opportunities. So, for example, I spent 4 years in Paris at the OECD. You can spend some same sort of thing in the IMF, etc., which is over in Washington, and it does give you a lot of experience. And, I've had the same job essentially for 45 years. So I was Treasury, OECD, and then NAB, and basically the chief forecaster in all those sort of areas. And I think a lot of people are saying, well, economics has got a lot of maths in it, but it's also, I think, got a lot of human interaction in it that's important. So I would say when everybody else is leaving, that's probably when you should be coming in. And I remember always when I left Treasury in 91 or 92, everybody said to me, you're going to Melbourne? Everybody's leaving Melbourne. So I think that's probably a sort of lesson from my point of view. Keep your options open. Economics is still fascinating, and it's worth getting your degree.
So how do you think you can get more young people to study economics?
Well, I think I just sort of say keep your options open, and economics does give you amazing opportunities. Now, I didn't think I'd be at NAB for 32 years. In fact, I think I told a few of my colleagues recently that I thought it had taken 3 or 4 years to figure out whether I was any good or not, and I had a contract for the OECD at the time. So it was going to be a temporary thing, but I think economics in Australia anyway, particularly if you can get into a big bank, is really good. The other thing I think is important now is in economics there's more use of data. And data you can use not just in the economics field, you can use it in all sorts of fields, from tax office to areas in health, etc. And so I think the other thing I'd say to people is get up your skills in data as well. They're really important.
That's NAB Chief Economist there, Alan Oster, reflecting on his 32 years in the role. Now, Market Day on the SBS On The Money podcast. Let's turn now to the Australian share market today, which fell by 0.7%. The S&P ASX 200 at 8,141. For more, I spoke with Ben Richards, an equities advisor. Ben, the market's
Seneca
down today.
Financial Solutions.
Why, and how much of it has to do with the tariff concerns?
Yeah, Ricardo, we think a significant amount is in relation to the US tariffs announced by President Donald Trump, particularly with Canada, Mexico, and China. China, obviously, a key factor in the Australian market as it relates to mining and iron ore, BHP, Fortescue, Rio, all selling off, with the iron ore price dipping below $100 a tonne for the first time since earlier this year. And yeah, I think more broadly it reflects the valuations of global equities both in the US and in Australia, and probably just a bit of healthy profit taking and risk off sentiment there.
That sell-off, though, is kind of across the board because banks and consumer staples were hit hard today too, though. Why?
Yeah, so banks more just a risk off sentiment. They have run hard over the last 18 months, particularly the big four, ANZ, Westpac, CommBank and NAB. Consumer staples, it is worth noting that Coles and Woolworths were trading ex-dividend today, as well as Treasury Wine. So that's, the bulk of that sector is particularly in the supermarket retailers. But yeah, large caps down in Australia on the whole. So bit of selling there.
Earlier, I spoke to Alan Oster from NAB about the Australian GDP numbers. Today, China said today that it's trying to maintain its 5% GDP growth target over the year. It's also announced a raft of stimulus measures. It all comes in light of this global tariff tensions. How has the market taken this, and just how significant is it?
Yeah, the market's really been searching for confirmation on Chinese stimulus for the last couple of years now, ever since growth in China has slowed down, affecting kind of the whole resources supply chain, including in Australia. Today is just kind of the latest cherry on top there. They've announced some issuance of treasury bonds, injecting some cash into the economy. We think that, yeah, that might flow down to the resources sector. And yeah, it's been a bit of a weak spot in the global economy and for global markets now for a little while. And China, as a result, will move from a GDP deficit of 4% from 3%. So there is a bit of a swing there, and global deficits, particularly in the US and China, are kind of driving a lot of that risk off sentiment and giving investors pause for thought when it comes to gold and other safe haven assets to kind of protect against that high government leverage situation.
Virgin Australia has appointed a new CEO. It's the Chief Commercial Officer, Dave Emerson. Is an IPO next?
Potentially. We've been hearing about a Virgin Australia IPO for a little while now. They, of course, went into administration during COVID, was listed on the ASX. Bain Capital's come in later in 2020, bought them out, supported the debt, and yeah, it's been kind of a turnaround story ever since. They did roadshow under a previous CEO, but the IPO market was pretty subdued and the window was shut, as colloquially it's referred to. And yeah, we'll see if Dave Emerson, who's a long-time Bain consultant based in the US, will energize Australian institutional investors who I think need to see a bit more clarity around the financials and earning stability, as well as just broader market conditions to support an IPO in the current market climate.
And finally, where do you see the opportunities for investors at the moment?
Well, as we see a bit of risk-off sentiment, gold is one area of the market which receives a bit more positive attention. The gold price is, of course, up significantly, over 40% in the last 18 months. So we see some value there in the producers and the developers. We've recently owned shares in De Grey Mining, which has been the subject of a $5 billion takeover by Northern Star Resources, one of the largest gold miners in Australia. And more broadly, we continue to see small caps as an area where we can generate slightly less correlated returns to the large cap end of the market. And in terms of global equities, we continue to favour emerging markets, ex the US, given its recent run and valuation premium.
That's Ben Richards there from Seneca Financial Solutions. Don't forget, if you enjoy the podcast, to give it a rating or a review on Apple Podcasts or Spotify. And
this SBS on the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.